right, we got JP with us, and we got a quorum. We've got enough to press on. Well, happy Friday, happy non-farm payrolls day. May the jobless rate forever be in your favor. Though today it was not. It was a pretty big miss. Not that I'd read any too much into that. And we certainly don't take positions based on how these reports turn out.
I missed that. What reports are you talking about?
Oh, non-farm payrolls.
Oh.
So here's what the picture looks like, and you can.
That was a shocker, by the way.
That was a shocker, and so this is just since 2015 to 2019. You can see this was today's. They came out with 25 actual forecasting 170,000, 300,000 jobs added before that. You can see that even in a strong job market, you can have anomalies like this. The other thing about these job numbers is it's so complex for the Bureau of Labor Statistics to compile these numbers. It typically takes them about 3 months to verify them.
Yeah, so that's why we have they renumber them and stuff, and they rewrite them and stuff like that. And we in the industry call them, they cook the books a little bit on these numbers. So take them with a grain of salt, never trade off of them. There's really at this point, and I can't even say for sure that these are the only ones, but PPI and CPI seem to be the only ones that don't get cooked anymore as far as economic numbers are concerned.
Yep.
So no, they're there. I mean, they're there. They're just so you don't walk in front of a freight train when trading.
Yeah.
But I personally would never ever trade off of them ever. Like this morning, what we saw it happen this morning. Those are terrible numbers. I expected the market to tank, but saw what happened.
Yeah, there you go.
All right, game over. Talk to you guys later.
That's it. Trading futures, which we will look primarily at futures, some equities, but any type of trading instrument involves risk, and it's always two things we preach over and over again that you can control in markets. They're about two things. One is how much you risk, and two is where do you choose to put that risk to play. So be mindful of that. Just a little background on myself. I'm Josh Schuler. I'm the founder of Trade with Profile, and one of our coaches kind of made the progression from trading as a I was thinking about this the other day, JP. I got into trading because I wanted something that gave me a better return than a certificate of deposit. Literally, that was my motivation.
So you picked up trading. You could have probably sold lemonade on the side of the street.
That was the thing that got me. And with me is JP, and we are the core of the Trade Profile team here to help you guide you today. And what we focus on, this is kind of the nexus of the work that we do, is to help build trading skill. So we're a skill development firm. So if someone comes and wants to be proficient and consistently profitable in the markets, we work on building a trading playbook. And we think that consistency, at least it's demonstrated in the work that we do, happens at the overlay or the intersection of mastery around three different objective focus areas. One of those is the 4 behaviors observable in every auction and how to observe them. One of those is 4 questions to ask and answer before you enter a trade. How do you answer those? And then 4 stages of auction competency and how to know which one you are in. So every week we work with our development community on a concept or principle that's working to build some aspect of these focus areas to lead towards their competency in the markets. And this week we're going to go after a trading challenge that has to do with when you come into a trading session or looking at a trading session. I think I did that last time. How can I quickly get a sense of the narrative of the auction so that I can have healthy expectations for where the auction might go next? And I apologize for the typos there. It really has to do with this idea of context. Like how do I determine a context in the auction? So when I first got started trading, I was a really good, I'd call it an order filler. I found someone who was kind of calling out trades, and I could follow those trades. You know, I was basically just an order filler. I was just executing trades, but I couldn't tell you where or why we were placing these trades. I couldn't tell you what the target was. I couldn't tell you why we were even interested in these. And the person that I was following, if that person was gone or I missed a day, I felt like I had missed the plot. And all of a sudden, I didn't know what to do with the market. And that's ultimately not how I wanted to behave around the markets. I wanted to have it, you know, because some people are going to move toward being a full-time gig like JP and myself. Many are not. Many are going to look at markets as a way to beat the yield on your savings accounts or your mutual funds, your IRAs, or to have a way to have it as a side hustle, but it's not necessarily a primary thing. Well, how do you enable yourself to be able to make good decisions and find good opportunities, consistent opportunities in markets without feeling like you got to be tied to the screens all the time, and feel like if you walk away that you can't find your bearings again. So this context issue is a deal. And if you've been around markets for a while, you've likely heard someone say, well, the context of the market is X, Y, or Z. And you're like, oh, that's great. I have no idea what to do with that. Like people talk about context, but they don't really necessarily say, well, then how do I actually discern context? And I will say that what's a benefit of the profile, which the profile is a tool that we use to arrange price data so that we can make better trading decisions. And the posture of the auction, because any market that you're looking at, it's an auction. Price is auctioning back and forth in search of value and in search of price discovery. And that the posture of how that auction is behaving provides a context for the trader to pull a selected strategy for the coming and current session. Auctions behave consistently according to their posture. So, and you may have heard someone say, well, markets are random. I can't know, which way it's going to go, which is true. It doesn't mean that you can't have a good hunch. It doesn't mean that you can't have a better than 50-50 edge on what is likely or what to expect. And so having a context around that and within the profile helps us do that. Without having that context, a trader will feel like he or she can't get away from screens, or he or she will lose the plot. So definitely an encouragement to look for context. And what I want to show you just real quick is a really simple way to establish context in the auction. And this is going to be particularly helpful for anyone who's looking for opportunities intraday, or maybe for a number, 3 to 5 sessions, from a swing basis. This is applicable in both futures and also in equities. And it involves your ability to see 3 variables. Okay. When you do this, when you've got your arms around this, you're going to be able to come into the session and have an expectation of likely behavior based on the posture of the auction every day. It's pretty cool. So here's what this looks like. And maybe the easiest way to show you this is I'm going to show, I'm going to pull up a chart here and just kind of walk you through what it is that we're actually looking at, and what I mean by context and how I'm going to see this. And by the way, if you've got a Thinkorswim account, and you would like this chart template, just send me a note afterwards, and I'm happy to share it with you. And then you can look at this contextual stuff as well, and interact with us, see what you find. But so it's three views of the same chart across different time frames. Okay, so we've got a 180-day or 9-month chart on the 6-month chart on the left. We've got a 20-day or 1-month chart here. We've got a 5-day or 1-week chart, and then we've got a 10-day, but this is it looks rather different. So these are time-based, candle-based charts. This one is what we call a market profile or a TPO graphic. Okay, and then we have a number of things on these other time frame charts. So this right here is what we call a volume histogram or a volume profile. So what this is showing you is it's showing you the intensity of orders placed. So this is historical orders placed at those prices within that time frame. So you can see that there are peaks and valleys that are represented across the range of price that has been seen within those. So right now in the last 5 sessions, there is a range of price from what are we looking at here? About 28.25 down to 27.26 in the S&P 500 futures. Okay. Now, I want you to point out that there is a price right here at 27.96 that is the largest peak. So we call this the fairest price or the most traded price. The technical term is the volume point of control. Okay, so this is the price where there was the most agreement between buyers and sellers in that time frame. So over the last 5 days, 27.96 has been the most traded price. Now, if I go to the 20-day chart, 27.95 is also the most traded price. All right. Now, if I go to the 180-day, 27.30, that's basically where we're trading, is the most traded price. So these two are in agreement, right? And so price is below that. So this is what I would call price is below the 5-day, which is equal to the 20-day, and that is what we call a posture of the auction. Okay, when that happens, as auctions will always move from an area where there's a price agreement, and then when they move away from it, so think of this as like value in the auction was around that 27.96 area, and now price is below that. So what would have to happen for price to continue to go lower, given that we're trading significantly below where value has been for the last week and the last month? What behaviorally would have to happen for this auction to feel like it had energy to keep going lower? Any thoughts? Value would have to migrate with price. So and why is that? That's just the right answer. What is the rationale behind that? Can be a little bit difficult to articulate. Let me actually pull a whiteboard up here, and this might be easier to see, because it's an inverse relationship. Oh, thanks for the note, Nick. I'll figure out what that is. So the example that I always use is a housing market. Okay, so let's say that the median house price in a market is $150,000. Okay, so $150,000 is the median house price in a neighborhood, and then someone offers they basically offer a house for sale up here, and let's say that is at $250,000. Okay, is that $250,000? If somebody's offering that for sale, should you buy that? If the auction or all of the recent comparable prices in the housing market have been at 150,000, is 250,000 a good deal? So think about that. So it could be a great deal if you're the seller, at least initially. And the reason is because if 150,000, is the median house price, you sold it above value. Okay, and now what would change the story is that if we started to see lots of houses transacting at 250,000, then the perception of value would actually migrate where the market itself would be accepting that 250,000 was value, and so then you might find somebody offering at 350,000. Okay, and then so same deal. This could actually be a it could be early. We need more data to know if that's a fair price or not. We need to see more houses transact at that higher price. If an auction can continue to transact in a price direction, then it's not over yet. It's only when we get to a place where we have house price like in my neighborhood right now. So we've got guys offering in this range, and they're just not getting the follow through. Okay, so what's happening is now the number of transactions is falling off. So if I profiled this over time, it might look like this. Okay, which means that who's left to get into this auction? I'm running out of participants in the auction. So what then ends up happening is auctions will revert back toward prior known areas. So if the 350 became an area, and the 250 was, like, it'll come back to those areas because the auction has a memory of where it is, unless we find a bunch more buyers that then builds out the profile and then allows us some opportunity to go higher. So if I reverse that and I inverse that here in the S&Ps, okay, if I've got value way over here, I've got a couple different nodes, but at the moment, this market contextually is a little overextended. I mean, you can see that there's this big bulk of trade up here, right? But as I'm getting down here, it's starting to wane. Now there is an area, there's a node right here, right? There's a node right here that if we spend enough time at those could be a reference. But right now, what I'm expecting is this market contextually, because of where it's at, if they cannot migrate near-term value lower, then the auction will go back higher to find value. It will do that every time. So this is what we talk about in terms of consistent behavior in the auctions. Is and in the time frames that most participants are active, from a trading standpoint, they're looking at them around these kind of time frames. So like I've been trying to teach my kids who are in high school how to trade, and I just tell them, hey, look for price relative to value for the last 5 days and then value for the last 20 days, and tell me the relationship. You will actually find, and this is some homework for all y'all, there are about 9 relationships that occur, and then the auction does consistent things as with respect to those relationships. And I even, as part of my trade plan every day, I put together something I call a quick sheet. And what this shows me is on a number of products that I'm interested in. Let me blow that up just a little bit for you guys. Okay, so this shows me that relationship. So like today, I was looking for longs in soybeans with WASDE report, because the last price is below the point of control for the last 5 days, is below the point of control for the last 20 days. So that's an auction that could be a little extended. If you're sellers down there, beware, right? Or gasoline, if you're buying gasoline, you're a little extended. But some of these where price is equal to, I mean, it could go either way. In fact, we had a big move in crude oil today, but that's not how it started last night. Last night, the auction was in balance, and when it's like that, that's a clue that the auction can go either way. And if we look at the the move, price started up here, which was in agreement with this value, and it has pushed away. Now, what's price doing? It's moving back toward value. Why? Because it couldn't get enough participation lower. And in fact, we took some nice long trades in crude today because of that. So that's a quick overview of the idea of context, and what I would recommend, commend to you to look at when it comes to context is that you look at the relationship of price to value within the last week and last month. I think you'll find that it is a very, very consistent contextual measure that then you could look at any product and have a sense of how you might trade that. And to illustrate that, what I would ask is, give me a product, something that you like to trade. It could be an equity, it could be a forex, whatever that is, and let's take a look at it. And we could do some examples there. And then also any other questions that anyone has with respect to trading, the rest of the session is for you. So, look, they're going to get those singles, Jay. Almost got them. I'm going to consider them good as done.
Yeah, that's good enough for government work.
Yep. And I'll go back over here and look at the beans. Yeah, they're pressing. Wheat's holding up a little bit better, but
yeah. Well, that 929 is keeping a lid on that market right now.
Yeah, yeah. And our Swiss franc is working okay.
Swissy.
The Swiss franc. Oh, cattle popped.
It wouldn't shock me a bit to see the indices in there, take out their lows today.
Oh yeah.
I mean, they're getting ready. Well, I mean, the ES is knocking on that door already. The Russell's right there as well, so wouldn't surprise me a bit into the close. Now, is that something we'll trade? Nope. We're done for the day. Anybody have any? Oh, here's a question. What was that? Wasn't trading today, but I was assuming Powell didn't say anything interesting. Considers not. Well, I don't think Powell spoke today. So I don't think that was it. He doesn't speak on NFP days. Usually the president says something, which I haven't seen or heard anything, but is what it is. 10 a.m. It's on the econ report, really. What was he doing? We shall find out. It is. Wow, that snuck in there. How come I didn't see that? Let's see.
Powell was speaking today?
Oh, yeah. He was just at Stanford at a class.
Oh,
talking about economic policy research. So, yeah, there's nothing going to be there. When he's going to say something, it's going to be in an open forum, or it's going to probably be on the Hill testifying. That's when, or after FOMC when he has his his report. So, okay. Scott says, what statistics does IRT provide for profile, say, for ES? I know you guys have provided a 17% number for 1.5 times IB, for example.
Yeah. So all of here's where I would point you. It's a good question. If you are an IRT subscriber, they have a fantastic homework series that I would recommend anybody who is a subscriber going through, that will help you build basically any premise that you want to test and check the statistics. They show you how to build those, and it's robust. It'd take you probably 6 months to get through all of these, but I'll tell you, I think it's worth it in fact, in not this next week, but the week after that, we're just going to spend our whole week is going to be spent on auction statistics. So that'll be kind of what we'll be talking about next week's Q&A. But having reasonable expectations statistically on the auction is remarkably helpful in terms of what to expect in the auction, and that can, things like coming into a day and going, okay, well, so there's a 97% chance I'm going to take out the IB range, or there's a 97% chance that I'm going to trade either the overnight high or the overnight low. I mean, like, that's kind of stuff you can lean against. Are there exceptions? Absolutely. But man, anything that you can build that has those types of probabilities is really helpful. And to that point, Scott, it would depend on which ones you found really helpful for our playbook and approach that we use with those in our trading community. How many times that, the key ones for us are, okay, if it's a gap, what size gap it is, what's the probability that gap closes? If it is, an initial balance, once we have extension, what's the probability that we'll get significant extension to how far? I mean, those are the chief statistics that we use. There are certainly other statistics that you could employ, and I'd encourage you to look through their deal.
Tony, let me understand your question. What time frames, context, 5 days, 20 days, 6 months, is the market involving, i.e. the current price is at the value areas in 6 months or longer charts? I'm not so sure I understand your question.
I think I do.
Okay, I'm sorry. I'm not that. Josh is a lot smarter than I.
So. So let's think about market memory, or let's talk about market memory. Okay, market memory has to do with what price references does the auction care about. Okay, so if the most sentient references are yesterday's auction, that's the first place to look. So where are we relative to yesterday gives us a view. So yesterday, for example, the most traded price in the ES was 27.50. Okay, so that's the closest and nearest reference for the auction. Now, obviously, we're trading away from it. Then if I was to come back, 27.50 would be the most recent reference. Let's say I come back towards that reference and then just blow straight through it. So one of the ways that we know and can discern that there's a larger trader active in the market, and this liquidation that we're seeing in the auction, this is the fact that we've basically traded 100 points this week, that we've moved almost 70 points in the ES since yesterday from Globex, is telling me that there's some distribution, that likely what was happening is this big ramp that we've taken since the December lows was an opportunity for some funds to get to cash. So they're basically using the rallies to go to cash. So that when you see price moving away from those levels that should hold the auction, and they don't, that's a clue that a larger time frame is at play. Let me give you a better example because of one that's where they've got divergence here. We're going to look at soybeans, for example. Okay, so soybeans, the 5-day here is at 902, and then the 20-day is at 916. All right, so price today after the WASDE report came up right to that 902 and couldn't get above it. So there was, at least what I'd call midterm participants who shut this auction down. If we had blown through this number, then that could have opened the door to go to a reference that has more participants historically, which would have been 916. And now there are, in auction theory, I will tell you that people will say specific time frames are not as important as like when you're doing your composites in the auction, when you're building composites, that the a time frame is irrelevant, which to some degree is true. But until you know how to profile a composite move, these fixed references work really, really well. And most people who are, interfacing with the auction are thinking within the last week to the last month. That's why those timeframes are effective in the auction. The longer term ones are really helpful when you go, okay, the market's really moving away. Where might it go next, or what might pause it? So that's why, with the gap after non-farm payrolls, I think even though we may see lower prices today, it's going to be tough for the ES. It's why we've paused where we've paused, is because we came into a long-term level. I mean, that's 6 months worth of data of participants there. So you would reasonably expect that they're going to slow the auction and go into rotations down here. And if we can't hold this level, well, then we've got another longer term composite that's around 2708. And then the next big level that I'd look for is this node around 2664, and we just kind of cascade, down through those as the auction goes back and forth between those larger term areas. Does that help, Tony? Cool.
It was good. Nicholas has a really good question here. This one we could spend a whole day on, honestly, Nicholas. I think it's it's a relevant question. So how much percentage do you put on human behavior to a stat? 97% overnight high, low is broke. But when you put a trader behind the setup, maybe the stat is only 65%, maybe 45%. What percentage factor do you discount away from the 97%? As far as the market psychology goes? This question is specific for both. Okay, so the question is, that statistic is derived by human behavior because it's humans, and it's the algorithms which are designed by humans, and then any other retail traders or prop traders that are actually trading that. So that statistic is derived actually from trading, which is actual traders behind it. So there is human behavior behind that statistics. Now, we may discount that depending on the type of day that's setting up inside the profile. And that's where we will discount that. Now, is there a specific number, 10%, 15%, 20%? No, it's not. It's that if we have a narrow IB, for example, on crude, which is one of our favorites, we know what that number is going to hold up. That thing's probably going to break. Okay. Now, if we have a monster super wide IB, like yesterday, how big was our IB in the NASDAQ yesterday, Josh? I can't remember.
300 ticks.
Yeah, that was a pretty big IB.
Double the average.
Yeah, double the average. So if we have that, we're going to discount it and say it's a discount to caution. Hey, we got to be careful if we're going to take that trade. It's going to take a lot of energy to get that thing to break and go. Josh, you have anything to add on that?
So the stats are helpful to build reasonable expectations. Like, let's say, for example, like this. Okay, I got a 97% stat that if I have not yet exceeded the initial balance range, that I'm going to. So if you're inside the initial balance, so if you're in the first hour's range of trade and you have not traded outside of that range, what is a healthy expectation for you to have as a market participant? Any thoughts? Yeah, I mean, let's look at the ES here. Let me explode this profile out here. Okay, so if I'm in B period and I have not yet traded above the IB high or the IB low, okay, and I know that there's a 97% chance that I'm going to exceed that range. So if I'm taking a trade, I need to be aware that one of those sides is going to be out. So that's either going to be way in my favor or it's going to be against me. And that's a healthy expectation to have when a stat is that strong. Now, are there indications when are there indications when we don't? Obviously there's exceptions to that. But if I'm building my approach on what's likely to happen and I make contingencies for when it doesn't happen, then I'm in good shape. One of the things that we encourage traders initially to do is do not take a trade until that stat is broken. So if like today in the ES, you would have not entered a trade until we had traded above 27.36. You wouldn't have even looked for a trade. Because now if 27.36 has been taken out, now I know that I've reduced the probability that I will take out the low. And I know that there are buyers who are willing to set up behaviorally in the session. And I've got a 27.54 as a potential target higher if I could close the gap. And so then now I'm starting to look for order flow confirmation in ways that I can express tight risk control to go in the direction of that extension. If it doesn't give me a pullback and say they just ran straight to 27.54, well, then I'm going to look for an opportunity around 27.54, expecting that settlers are going to step in, and I'm going to look to trigger back towards today's IB range. Like it's a cascading probability. So in terms of statistics, think of them as they further inform each other. So okay, the first stat is the initial balance breaking. Okay, that's a reasonable expectation to have. Second is the tighter the IB is relative to its average, tends to predict greater probability of extension. So today, where we had an about average initial balance and we had already extended past the expected range of the product, when we extend the IB back in the direction of the gap, that makes pullbacks into the initial balance favorable to look for opportunities to go long. And so, like what that would have looked like. I mean, I did not take a trade. We took one in the NASDAQ, but let me show you what that would have looked like in the ES, at least from my perspective. Okay, so here's the break. Here's the break of the initial balance on this order flow break right here. Okay, so then I would have been, if I wanted to go towards the gap close, that's the trade. I've been looking for a go with trade on that one, and so I'd be looking for a pullback to get long. We got a pullback to get long. They did a little bit of balance back in here around the VWAP. They pushed below, and then order flow came back through. That would have been the area that I would have been entering. This is the stop, and I would have been looking for target back up in here. And then after this pullback, this area of consolidation, once they popped above that, I'd have moved the stop there and trailed it. And I would have either taken profit up here or I would have been stopped when they came back through there. Is that helpful? It can get easy with the statistics to overthink the statistics. They're really not meant to give a guarantee, and especially those who want to build a perfect system or want to think algorithmically around it. It can become a hurdle where you end up overthinking things. And
I would concur. I think that the statistics tell you if there's an edge anywhere, or it's apparent there's an edge, which there is in that, obviously. But if you lean on them to the point where you're trying to decipher, what I would call just outside variables, it's good. It's really difficult. I mean, just understand what trading is. Let's go to the psychological side of things. Trading is just this. You define an edge, right? Where the idea is not. Let's go back one more step. I'm sorry. So trading's not go out and make money. That's not trading. Okay, I know that sounds foolish because a lot of us got in, like Josh said earlier in today's call, he got in because he wanted to do better. okay, which is a form of making more money. But in trading, you have to have an edge to be able to trade. Okay, that's why a lot of people don't trade. They don't understand it. They think it's just, you know, gambling or whatnot. But you have your edge, and your edge is based off whether it's a technical setup, whether it's a probability, or whatever that may be for you. We tend to use probabilities, and you know, we use technical obviously with the profile, but we also use percentages, right, which is a form of probabilities. Then from there, it's about executing and trusting that. I think I spoke of this last week if you're on our call. We talked about trust. You have to trust your setup, your methodology, and your analysis. You set your risk based off that trust. And when I say trust it, let it play out. Okay. If it goes against you a couple ticks, that doesn't give you the right to yank out of the trade and go, oh my gosh, I shouldn't, you know, that thing was going to come stop me out. You can't be, that's something psychologically you have to accept in life. There are going to be stops. So I'm going to caution you, if you're really trying to narrow your system down to make it a 90-95% accuracy rate, you probably will be disappointed going forward in trading. I don't want that for you. I want you to become a better trader in the head rather than on the chart, actually, because that's where your success is going to end up ultimately being from. Does that make sense?
Yeah. Yeah. Nick, I mean, your comment, I mean, you're right. You think stats draw too much of a bias on events. They're good to keep in mind, but to drill into your head day in and day out, you look for something that isn't there. Yeah. I mean, if you sit there, because what you don't know is you don't know which day is the exception. You just don't. You know, so it's like if I flip a coin enough times, I should land heads and tails about 50-50, but I don't know, you know, I could totally hit heads, you know, 10 times in a row easily. So I don't know which one is an exception, but where you can increase the ability of that is, you know, having a set of realistic market conditions that kind of all inform each other, where you're stacking probabilities. So the more things that if I leaned on just one stat, well, that's not really helpful. But if I'm looking at the congruence of 4 or 5 different consistent auction behaviors, now it does actually build an edge around it. And some of that, I mean, when we talk about the 4 stages of auction competency, at a stage 3, which is a conscious competency where you're having to like think through in your head, you know, like I'm thankful, I'm blessed really where I am right now is that I've trained my brain that I can make a decision behaviorally because I've already quickly done the math on, okay, we hit that stat, this stat's still open, this one, in like, I just know them. It's also why you just kind of need a few key ones to give you a reasonable expectation in the auction. You don't need a whole bunch of them, but where they can overlap and help each other, then man, it gets to be really powerful. And at least it was a game changer for me. And I realized that for some, it can become too much of a focus. I think that's a caution there. But if you come to markets, you've never even seen markets before ever, and you have nothing to do, just even using an average trading range is a useful tool, right? Because if you come in like today, the ATR in crude is $1.40. Okay, when crude is trading at $1.99, how, you know, could crude extend lower? It sure could, absolutely could. Is that a wise decision to go short? Likely not, at least not in the current day session. You know, you're starting to stretch the stats. So we could talk in fact, we're going to talk a whole week about it.
Yeah, no doubt. So I'll challenge you guys, go back, and if you're currently trading or have traded, go back and think about those trades that you took, okay? And ask yourself a couple questions inside those trades. Now, it's easy to speculate what we're talking about now, okay, before the trade happens, but I'm talking about inside the trade now, the tough part. This is when the rubber meets the road. Did you get out of that trade too early? And if so, why? Did you take any profit off? Why were you in that trade in the first place? Okay. Ask those questions. What you're going to find out is, I'm going to give you a percentage here. Okay. We're talking about percentages. 90% of your mistakes are going to come not because of the setup. It's going to become the way you react to the setup. And that's huge. And I can't tell you how huge. We talk about the profile. We love the profile because in my world, that takes a lot of the psychological issues out of my out of my way, because I know what I'm looking for and I know what to trust. Okay, that's my trade. I'm taking it. Okay, and it's based off X, Y, and Z. So when you guys are building your plans, it's based off of X, Y, and Z. Now, when you're in the trade, how do you handle yourself inside that trade? That's the other component to success in trading on that. So yeah, we cover a lot of that stuff. That's what we do in our Slack channel too. We work with a lot of people on that side of it, because what we find is, let me see, is Joel in here? I thought I saw Joel in here. Yeah, Joel's in here. Yeah, Joel's great. Joel works with us, and I'm not picking on Joel or anything. Joel's been working extremely hard on his trade plan, his methodology. He's doing a phenomenal job. But more importantly, I think his biggest thing is that he's recognized what's happening in his trades while he's in them. Okay. Or recognizing, maybe like we just saw today, where he realized he shouldn't have been trading at all because something else was happening in his life, and that was taking him away mentally. So those are very important components, guys, of trading. I can't discount those at all. And great job, Joel, because you're rocking, man. You really are. All right, anybody got any other questions? Anything we can answer for you? Doesn't matter. Psychology, charts, you name it. Josh has all the answers.
Yeah. I'll give you an answer. I don't know if they're any good.
Yeah. Okay, so here's the truth, guys. We are not gurus. Okay, what we have done in our life is we've made every mistake in the book. Okay, why? Because we've been around for a long time. And if that brings you guys value and helps you understand what maybe we've seen in the past, then so be it. Okay, you'll never find a guru in trading. The guru is within yourself. All right,
preach it.
What's that?
Preach it.
Hallelujah.
Hallelujah.
Sounds like those tent revivals out in Western Kansas. So, ask away. And there's no dumb questions too. I love this because I know somebody's in there. Well, if I ask that, I'll make me look dumb. Hey guys, we've already made that mistake, so you can't be looking dumb. So I promise. I've yet to come across one we haven't made. Did I tell the group last week my mistake I just made?
I think you did, but for those who weren't there, you should tell them.
All right, we make mistakes, guys. I'll tell you one of mine. It is a stupid mistake. And if you've been around these calls, which I think I recognize some names again. Nothing like telling your wife the mistake you had to make, or you did make. And so I was trading. It was about a week and a half ago, and I was looking for an entry, and I had some orders out there, and it didn't come to me. And my rules are, hey, if the trade doesn't come to me, it's not a trade. So I'm taking everything off, and I took everything off, and I got sidetracked, and I wasn't paying attention to the screens. And I was, at the end of the day, there was no trades for me on that particular instrument. So I was closing out my charts, and I got a notice saying you have an order open. And I was like, what? And I'm like, I had no orders today. I'm like, uh-oh, that's not good. And so I went searching around. And I found out I got filled on an order that I had out there. It was above the market, and I didn't even notice because it was going to be a target of mine, because I like to enter my targets based on the way that the contracts work at first in, first out, last in, last out type of deal. So got filled. At this point in time, Trump had made some comments on China, which put that trade well against me, and I hit out for a sizable loss. Yeah, pretty stupid on my part. I will be the first to admit, but they do happen, guys. So there's nothing to be embarrassed about. Now, the hard part for me wasn't the loss. The first thought that came to my mind was, oh crap, I got to tell my wife about this, you know? So people are going to ask, why do you tell your wife? Well, okay, first, my wife was a trader. And so she knows everything about trading as I do, or knows what I trade and how I trade it. And we talk about it frequently. That's a lot of our conversations, how the markets are going, how you doing, what are you thinking, you know? And she knows that I can't lie about that kind. I've tried, doesn't work. She's like, you liar, you know? So yeah, that was a fun conversation. And the steely eyes I got back on the other side were enough for me not to try to make that mistake again. So, what did you do right this week? What did I do right this week? I didn't trade some of the time. That's what I did right. What did I do wrong? I missed a couple trades this week. I did. My focus, Nick, that's a great question. I really like this question. My focus wasn't 100% this week. Okay. I missed some easy trades this week for me. And, obviously the result of that is less money. I mean, I'm plenty green on the week, but it could have been a greener week. And so how do I make that better? Is I go ahead and I take all my distractions away. If you've got multiple distractions on your trade desk, you need to hold on a second. You need to clear those, just like that distraction. You need to clear those off your desk. I remember it was Mark Douglas. Now, the late Mark Douglas passed away a few years ago. He was probably one of the best market psychologists I've ever heard speak. He used to say, listen, put a masking tape ring around your desk or your trade area and make it a specific area. When you step inside that masking tape ring, it's all trading and nothing else. Nobody bothers you. Nobody, no phones ring. Nobody answers the phone. None of that. You step outside that ring, you can do whatever you want. Inside that ring, it's all trading. So for me, it's all about focus this next, next week I'm off. I'm on vacation. So there's going to be no focus for me. So I'm taking a week off. We got spring break. And so I'm going to enjoy some of my family. But when I come back, it's going to be about focus on me, so I don't do that kind of stuff. So, sorry, Josh, I took your time up. You're right.
No, not at all.
Thanks, Nicholas, by the way, for the comment.
Yeah, I appreciate that. That's yeah, I would say I felt really good about my week. I didn't. I think what I did wrong is I think there were some positions I could have been larger in. But in terms of time frame, one of my assessments from last year was that I was too active. Like when I looked at my performance, I was too active early in the session trying to get into the real volatile stuff. And so I just decided, you know what? And I live in Mountain Standard Time, so it's an early. If you're going to catch the bond open, that's an early day. And I was just like, man, I'll just wait. Let's wait for an hour. And all of my logs, my trade logs, show that my performance significantly increased for me personally if I waited after the IB was formed in any product. So I've been really good at waiting this year, and only in very, very distinct scenarios am I active before that. Which has been great. It's given me more time in the morning. I come to the markets more refreshed and enjoyable. I'd say the only thing that I wish I'd done better is just some more size. Like I think back through trades this week, and I'm like, yeah. And this is one of the great things about markets, right? Is what other business out there do you add one contract or add a contract and grow your business, and if you're trading 5 contracts, you trade 10 contracts, now you just doubled your business. Where else can you do that? It's infinitely scalable. Obviously you can infinitely scale the risk as well, which we want to be aware of, but That's a pretty cool thing. That's something that I'm always, working towards greater comfort with greater size, and size appropriate to the account. And I brought up RBOB here just as a quick illustration. This is gasoline futures for what we were talking about earlier in terms of context. But last night, RBOB showed up. You can see that the 5-day was at 175. Price was above that at 179, and the 20-day was at 142. So that meant to look for RBOB to move lower, and just look at what RBOB did. From where I, posted that, it came back, and it came back to that 5-day, which also allowed for, because the 20-day was down here, it allowed for that to get a little bit more volume and migrate back up there. So that we've had a change in posture take place throughout the day. But that extreme that happened earlier said, hey, be wary of being long unless we get a pullback to the 5-day, which we did. So that's a way that you can use those to keep you from getting out of sorts.
Awesome.
How's a short squeeze, wash and rinse, price actions in market action context?
So guys, I know we're wrapping up here in the last minute. I know Tony's got that question, and we're going to answer that, Tony. I'm going to have to run here, guys, a couple minutes early. I apologize. I've got somebody who just stepped in my office I needed to talk to here before he leaves, and that he is my son. So that's my appointment in my office here. So I got to talk to him before he goes to work. So I'm going to let everybody go. Josh, are you going to hang out for a few minutes?
I'll hang out a little bit longer.
Okay. Hey, guys, appreciate all of you being around and joining us for the call. Hope you guys have a great week. I won't be here next week on the call, so if you're back, I know Josh will take good care of you, of course, and then I will see you guys the following week. Other than that, have a great week, okay?
Excellent.
All right, take care. I'll talk to you, Josh.
Okay, see you, buddy.
Yes.
Okay, short squeeze. How is short squeeze? So ask me more about that, Tony. I think I know, but I want to know more about that question. While I'm thinking about that, I'm just going to jump ahead here real quick. So Nicholas says, how do you deal with variable payouts of the market? Some days you lose money, some weeks you make some you break even. This is a great question. So I think trading more than a lot of trading is what we call involves nonlinear income, meaning because, and this is kind of a first thing to watch. If you come in, and people who want to get income out of the markets, they come in the markets and they think there's a number that they've got to hit. So they just run the math and like, well, I need to make this much per month. So if I switch that out, I need to make this much per day. And then that becomes their goal, which is not helpful. And the reason it's not helpful is because the opportunity is not the same every day. So, some days, like if say I needed to, if I made to make $60,000 a year, and that means I need to make $200 a day. Okay, well, what if the market offered 1,000? What if it was a really wide day and there was great opportunity? What if what if the market was 10 points wide in the NASDAQ? Well, one contract's $200. So, what's the probability you're going to get the whole range? Not great. So unless you're doing multiple contracts, it wasn't there for you that day. I mean, and we've had days where literally the NASDAQ is 10 points wide. Days when the ES is 3.5, 3.75 points. It's painful. So a couple ways to deal with that. One is to, if recognize what's the relationship of trading to your income. So, I mean, I still have other consulting that I do on a regular basis that smooths out the income for myself. So having another gig can help smooth that out, is one way. The other is just, as you're consistently profitable in the markets, if you can look back historically and say, okay, say on average last 6 months I've done, I don't know, 6 to 7 grand a month, then, what's is it if I take a smoothing average out on that, what's a number that I could reasonably expect that doesn't put too much pressure on myself, and then try to live off of that smaller number is the general way that you do that. And then I also adjust for volatility levels. So if the auction's more volatile, and here's what I mean by that. So my goal when I come in every day is to capture about 25% of the expected range of the product. That's my goal. So like today, crude oil was, where's my plan here? So crude oil came in with an expected range of 94 cents. I got close. I got 30 cents in crude. So that was, about an A effort. So I measure it based on what opportunity is out there, not on a specific dollar number. So like times when in crude oil is expecting $1.50, well, I'm going to look to try to get 50, 60 cents out of that, relative to what the opportunity is in the market, in terms of how I know whether I'm where I need to be. But that's how I deal with the non-linear nature. I will say that it's helpful to not put stress on yourself to try to hit a number. I was working with developing a trader that was kind of his deal. He came in every day and he had a goal, a notional goal that he was looking for. And man, that meant that there were days where it just wasn't there. He stayed around all day long. And there were other days when he went home way too early. So as best you can, stay away from a notional value that you're looking for and look more towards what's the auction presenting to you. And then once you got a track record of consistent profitability over, I would say at least 6 months, then you can start budgeting around that. Is my 2 cents. And it's also, it also depends on your personality. You may find that just having trading income is never going to be safe enough for you. So have a side gig. Do something else that's going to give you at least some consistent income to smooth it out. Okay, short squeeze. Is there such a thing as a short squeeze, or is there such a thing? I mean, we talk about squeeze. Tony, we do talk about squeezes in the market. Squeezing does happen. It is hard necessarily. It is a little hard to discern where a squeeze occurs. I'll tell you that the best way to discern where a squeeze occurs is where you see impulsive behavior that doesn't get follow through. So let me find. Let me think about an example from today. Yeah. Here's one. This is where we use order flow a lot. Order flow and understanding where you are in the current session. So let me expand this out. Okay, so there's a short squeeze right here. And why do I know that's a short squeeze? Well, a couple things. Note where we were in the day. So we were above the initial balance. Okay, and we're into a lower volume area. So it's a vulnerable place for a buyer if they don't get people to go with them. And here's a punch higher. Now, impulsive behavior should get follow through is my rule of thumb. So if I see impulsive buyers, I see buying volume and them hitting the ask, it should lead to higher prices. If it does not, then it's likely what was happening was there was sellers that had put buy stops in there, and they just got run out. And in the combination, you had some late buyers who got shorted. So the fact that I see right here, I see some impulsive buying volume that doesn't go any higher, that they were just blowing out some sellers, because then you can see then the auction follows back the other direction. So one of the cool ways to keep yourself from getting trapped by this stuff is if I see an impulsive move like this, I want to see them hold it, and I'll mark where the base of that starts. And as long as they hold that, then I'm seeing that as new activity that they're accepting to move in that direction. If they trade swiftly back through that, then that was likely just to blow somebody out and get somebody trapped. Yeah, I mean, I hear you, Nick, about if with footprint charts, you can see squeezes visually. It's still subjective, and I've talked to Trevor about it, and it's still subjective. And the reason why I don't think you can objectively say that that is a squeeze or that's not a squeeze. You don't know a squeeze until after the squeeze has occurred. If we were on the floor, okay, if you were on the floor and you could see everybody behaving on the floor, I think you could definitively say, yeah, that was a squeeze as it was happening, because people would know other people's positions and they would know who was active in that and they would be squeezing them. It is a little bit harder when we're removed from that dynamic. So I mean, I think you can see similar things in footprint where you can see stuff like this, where you can see impulsive order flow. That you can absolutely see. You have to kind of wait to see. I mean, this is my opinion. This is what I lean on, and it works for me. Is that if I see impulsive behavior that gets follow through, and I just start with it should get follow through, and then if it doesn't, then I do the next thing. They're certainly easier to discern at extremes, but I hear you. I definitely hear you. Okay, gang. Any last minute questions going once? Go twice. If is footprint chart the question? So the question is footprint chart too small of a time frame for me? It's not. It's footprint and order flow are fantastic for scalpers. Okay, so if you're in the game where you're looking for, if you're in the tick game in the ES and that kind of stuff, it can be an effective tool. And Anthony at Market Delta, that's who he is. Like that's the type of trader he is. So it's very effective for him. I'm not interested in a couple ticks. I mean, I'm an intraday swing trader. So, I want a position that I can sit in. I don't have to I can establish stops and can move with it. And I use order, in the bid-ask delta that I'm looking at in window trader, that's allowing me to see what, I would look for in footprint. I think from a risk control aspect, footprint, bookmap, order flow is extremely helpful in mitigating your risk. It can also get you in a situation where it's giving you all kinds of false signals. So, this is one of the things that I love about this platform is, okay, I've got, let me turn this off. Okay. Most of the time I'm looking at charts like this, and it keeps me from looking at the order flow and getting lulled into a trade that I shouldn't be in, that's not according to my plan. And it's only if and when I get to an area that I was looking to be active that then I will turn that up and go, okay, now I'm looking for, the behavior, to be in there. And, so like if how that would have worked is, so I had this level, in the market early on, that I was looking for us to test from the upside. Well, we gapped below it. And so then that level is still valid, but it's from the downside. So you can see we came into this area and, went around like that. So when they pushed above this sucker and then went back through, that right there is a short trigger for me. I would use that as my risk, and my target would be back into the current day's point of control. So I'm using, first and foremost, I'm using the day time frame. I'm using the probabilities of further extension, where we are contextually. Is the auction able to get follow through? The fact that they couldn't follow through there, that made this interesting. If I just looked at all of the order flow, I could find, and get lulled into stuff all over the map. And over trading, that's a great way to blow up your and ensure that you don't get success. I'm looking for 1 to 2 trades in a product a day, essentially. So yeah, that's why I don't use them. Yeah, that's okay. That's the deal. Hey, if the context stuff is something you want to press on, that's what we're gonna be covering next week. In fact, that's your homework, is to monitor the relationship of those 3 key variables: last price, rolling composite volume point of control of the last 5 sessions, the rolling composite volume point of control of the last 20 sessions, and note the interplay of them. We offer a free week for anybody who wants to. So if you want to add that to your trading approach, just jump in with us next week and explore that. Interact with us on Twitter or Facebook, and always open to, if you just have further questions, if you want some of those templates that we showed you today, shoot us an email or give us a call, and we'll get back with you as we can. We'll be back next week. Everybody have a fantastic weekend. Really appreciate your questions and your participation. And for all of those who are in our community, I'm looking for y'all's progress reports over the weekend so I can review those, and we can get ready for a great week of trade next week. Have a good day, and